local front, we've got the interest rate decision coming out, Kevin, and that is obviously, as Bridget Taylor was saying earlier, there are a number of currency strategists, market strategists, thinking that we will see interest rates remaining on hold. There are those others that are calling for a rate cut at this juncture.
Yeah. I think the market's quite right in probably expecting their interest rates to be on hold, and our readings from the communication from the Reserve Bank is that they shouldn't be expecting a rate cut this week. However, I think the chances of a rate cut later in this year, possibly in September, are increasing. It's a very benign environment globally. Inflation is well under control locally, and after the effects of the World Cup, I think there's going to be a pullback. And I think there'll be a room or an opportunity for rates to be cut one more time.
I want to come back to your overall or overarching investment strategy in the current environment with, again, all these mixed data points. You're not really sure where to turn. There doesn't appear to be enough positive data to say that we are clearly out of the woods. In fact, at the moment, it looks as though we're leaning towards that double dip recession scenario.
It does. I don't know if we're going to see a double dip in the US yet. Certainly we're going to see a moderation in the growth expectations, but a double dip in Europe, quite possibly. A double dip in the US, I'm not entirely sure. If we do see a double dip in the US, it's obviously going to be bad for equity markets. And the key indicator that we're looking at for that, among the huge amounts of data that's coming out, is the 10-year government, US government bond. At the moment, it's on a yield of about 2.9%. If we're seeing that edging towards 2.5, it will imply a double dip as well as probably a very deflationary scenario. That would be very concerning for equity markets globally. However, if we see that yield edging up to 3.2% or so, it will mean a lot more breathing room and probably a stronger US recovery than what we're forecasting.
Why don't you see a double dip panning out in the US? There are those who are saying that the Eurozone is taking its medicine right now and will possibly be on a stronger footing than the US, which continues its expenditure. And if you look at the states, the majority of them are technically bankrupt. At the moment, we don't see a double dip in the US at the moment, although we're fairly defensively positioned if that's one of the scenarios that comes to the fore. The reason we don't see it at the moment is we rarely see a moderation in the growth expectations. So previously the forecasts were up at about 3% for next year. They can pull back to 2%. The US economy, although is very inconsistent at the moment, there's still some underlying strength there, and although the consumer is rather absent at the moment, which makes up 70% of the US economy, the US consumer. Well, one of the things, what we're seeing is the absence of the US consumer. But if you look at the consumer rates, we're actually at a level slightly above where we were in 2007. So on a nominal value, consumer spending is actually ticking up without it being glaringly obvious to market watchers. The other thing that we're looking at is the opportunity for capital expenditure from companies to come and perhaps fill the void there as well. There's $1.8 trillion worth of cash on US companies' balance sheets at the moment. Some of that we think will be returned to shareholders through dividends or share buybacks over the next few months. You'll probably see an increase in those kind of announcements, but there'll also be capital expenditure that will take place by US companies, and that will have a stimulatory effect in the economy. They won't do it too quickly because a lot of those companies are looking for job growth before they start splurging on their investments. And the job growth will only come once those companies start splurging on their investments. So there is a scale to be balanced there, and the one won't run ahead of the other. But we think capital expenditure is something that could come to the fore. It doesn't mean that I'm overly bullish, but I am saying it's not all fall down yet. Not all fall down. Are there then opportunities on the local front that you would be exploring right now? Yes. I think some of the diversified mining companies such as Anglo's and Billiton are starting to look rather cheap on a forward PE basis. They are looking cheap if we do not experience a double dip recession in the US. They won't be so cheap if we do see a double dip recession in the US. And so Anglo's and Billiton, a few of the other diversified miners, we think look all right. Exxaro is another one that we like, and we like the coal sector as well. Pick n Pay today launched its major 628 million rand distribution centre in Longmeadow, Gauteng, the efficiencies and success of which will enable the rapid rollout of 4 distribution centres around the country within the next 3 years. CNBC Africa's Mashudu Masuta caught up with Nick Badmington and asked him about strategy in Africa now that the company is out of Australia.
We've always had an Africa creep strategy, so the trick is to move into the SADC countries, and we're opening in Zambia on Thursday morning with our first store. We've got a partnership in Mozambique that is on the go at the moment, and hopefully have our first store there in December. And we're looking at Mauritius and some of the other countries. TM in Zimbabwe, we're already in there. But essentially, lots of people very interested in the Pick n Pay brand, Malawi, etc. And just slowly, we will move into Africa and make sure that we get it right.
Just slowly they'll move into Africa and make sure that they get it right. Are you a buyer of Pick n Pay at 44 Rand 60 rather?
We're not a buyer. We do think all the food retailers are fairly well priced at the moment, and so we don't see glaring opportunities at the moment. If we'll have to see how that story develops, but the food retailers have been excellent performance for the last 12-18 months. We're actually lightening a bit here and looking for value in other sectors.
And Mashudu also asked Nick what Pick n Pay was doing to regain market share that they had lost during the recent recession.
Well, the big thing is for us is we're focusing on our business, ensuring that we change with the times. That is the distribution part and that, and then move into we're changing our buying into a category buying. But for the most part, with market share, we're ensuring that we have an efficient business first. The consumer likes the business. Since we've changed the brand, they love the brand, and I believe we've converted all our score stores. And we have a strategy to go for LSM 4 to 7 and LSM 8 to 10, and that'll start to pan out in the next 6 to 12 months.
You said that the food retailers have been excellent performers to this point. If you were to choose between a ShopRite and a Pick n Pay, where would you put your money?
Good question. At the moment, I'd probably go Pick n Pay. One of the reasons is, well, at the moment, I think ShopRite is priced to perfection. It is the one that's growing their profits at a far greater degree than Pick n Pay is, but I think Pick n Pay offers just slightly more value.
Pick n Pay offers slightly more value at this 44 Rand 60 level. Again, coming back to the bigger picture on the top 40, and what is attractive to you, if anything?
Yeah, I've been saying for a little while the IT stocks are attractive.
Did you catch Dimension Data NTT on the right side?
We had a few clients who were favorably positioned there. I still like some of those IT stocks. Datatech is also one that we like.
And it pulled back Datatech some 19% during June. It
has, and it's also a very geared to the rand. In fact, I think 90 to 92% of its revenues come from offshore. And we think that the trend in the rand is probably flattened out to turned. And if we're going to see some rand weakness in the 12 to 24 months ahead, Datatech will be a favorable beneficiary of that. And then if for those clients who have an appetite for smaller IT stocks, I think EOH has also had a good run, but probably some more left in it. Pinnacle and Mustech also look attractive.